In this presentation, we will take a look at the common managerial accounting decision related to equipment or large capital purchases, large purchases of something like equipment or property, plant, and equipment. Question being, should we keep the current equipment that we have or should we purchase new equipment? And yes, this would relate to us personally if we're thinking about large personal purchases as well, things like cars, or replacing large appliances and items such as this same type of decision-making process. Note that as we go into this decision-making process, we're talking about items that are going to have an impact many periods into the future. That's what makes them uncommon as well. So when we talk about normal accounting processes, obviously the day-to-day processes are going to be things that happen on a day-to-day process. When we think about capital investments, or putting money towards larger investments, things like equipment, things like a forklift or something like that, they are not going to be the most common type of decisions. They're going to only happen periodically, and therefore there's not like a systematic kind of setup that we have to go through the decision-making process to make these larger types of decisions, and therefore we want to set up a formal decision-making process to make sure that we avoid things that could cause problems, things like a sunk cost effect. Also note that this type of decision is something that's going to have a relevant impact multiple periods into the future, and therefore we could take into consideration time value of money. We're not taking into consideration time value of money right now because we're focusing on relevant costs. In a future presentation or in future lectures, we'll talk more about and focus in on time value of money and how to take time value of money into consideration when making decisions that will have an impact on long-term into the future, years into the future. So let's take a look at this decision. Here's going to be our information. We're going to say that the book value is $81,000. The remaining life is 5 years. The cost for the new equipment is going to be $120,500. Salvage value, meaning if we sold the equipment right now that we currently have, is going to be $80,000. The reduced variable cost per year for 5 years is going to be $20,000. In other words, if we purchase the new equipment, it's going to save us in efficiency $20,000 per year because we're going to be purchasing better, newer equipment. So let's go through that one more time. The book value of the old equipment is $81,000. The remaining life of the old equipment is 5 years. The cost of the new equipment is $120,500. The salvage value, in other words, we're talking about the salvage value that we could sell the old equipment for. The money, the inflow we're going to get for the selling of the equipment is $80,000. And the reduced variable cost per year for that 5-year time period that we would be having the old or the new equipment is $20,000. Again, note some simplifications we have here, of course. We're considering the 5-year time period that's for the remaining life of the old equipment, as opposed to differing time periods because the new equipment may last, we may estimate it to last 5 years or some longer period. We're also not considering, again, the time value of money with this calculation. What we are focusing in on are what are the relevant costs, what are not the relevant costs. The thing that's most confusing when we consider the relevant versus the non-relevant costs are the sunk cost effect. In other words, you would think when you calculate a problem like this, an important component would be the book value of the old equipment and the remaining useful life and possibly the calculation of the depreciation. You might think those things are going to be part of the calculation. However, they're not, because the cost that we have in the past, the money, the outflows that we have is already gone. So the fact that the old equipment's on the books at $81,000 doesn't matter to us. The depreciation may matter, but not because it's a relevant factor in our decision-making process in terms of value. It's only because it could affect taxes. So if we got into more detail, we might have to figure out what the tax impact would be, and we would have to figure out the depreciation in order to do that, because depreciation is typically an expense or deduction with relation to taxes. But other than that, the book value is not relevant, which is very difficult to kind of think of. I mean, you think we spent all this money on this old piece of equipment. If we're thinking about buying new equipment, it's very logical, or it's very difficult to say that the money that we spent in the past is not relevant to the new decision-making process. And just note that, for example, if you bought the equipment even yesterday for $81,000 and you think it's going to last 5 years, and then the day after there's some new innovation that makes that equipment obsolete, then the fact that you spent $80,000, you can't get it back, is gone, right? The question is, do we need the new equipment at this point in time going forward? And the fact that the 80,000 is gone or the 81,000 is gone shouldn't be a relevant factor from this point forward. It's a difficult concept to think of, especially when you're talking about large dollar amounts. So what we're going to do is we're going to take the incremental income. It's going to be the cost of and the incremental expenses. So the cost of the new machine, we're going to put this on there as a negative. So this is how much it's going to cost for the new piece of equipment. We're going to put that as a negative because it's going to be a cash outflow. Then we're going to have the salvage value. This is going to be the selling of the current equipment. So we think that we're going to sell the current equipment for 80,000. Again, that's close to the book value, but note that those things aren't related at all, because the fact that the salvage value happens to be close to the book value will not always be the case. It might be the case, but those things aren't necessarily related at all. It really depends on when we sell the equipment and how much salvage value we're going to get on it, which we don't really know until we actually sell the equipment or salvage it or scrap it. And then we have the reduced variable cost per year for 5 years, 20,000 times 5. A big component here, and note, again, we're not taking into time value of money here. If we were, we might basically amortize this amount in some format to consider the fact that the 20,000 in the next year and the next year is worth a little bit less in current year dollars. So just be aware that that's not where we're focusing in here. When we focus specifically on time value of money, we'll take a look at that. This is more of a quick calculation looking at relevant costs. If it was a close call, then we'd probably want to get into more detail and get into more specific time value of money and take it into account things such as the tax impact of a decision such as this. So the incremental income then is 59,500. So we have the machine minus the 80,000 and the reduced variable costs. So the machine is going to cost this much, but we're going to gain income of this much, and we're going to gain in terms of productivity 20,000 a year for 5 years. That comes out to the 59,500. So what should we do under this scenario, under this calculation? We should replace it. Once we come to that decision, if we come to a decision such as this, using relevant costs that we should replace it, then we would probably go into more detail before we do so, breaking the time value of money of this calculation out and possibly breaking out the taxes if it's a significant portion or significant costs to us, just to have a more detailed types of calculation. Again, we'll talk about time value money in a separate presentation or a later time.